Now, gold, if I look at the price level when I grew up in the 50s, gold has actually outperformed some items. Like gold has gone up more than the price of a loaf of bread. Or gold was at $35 in 1970. Now it's 2,650 or whatnot. So I can say the gold price has gone up actually more than some buildings have gone up. Certainly, commercial buildings lately in the US. I have to laugh because all I hear is they will never let anything go down because they can print money. Well, in commercial properties, they could print as much money as they like, and prices collapsed.
In a compelling analysis of gold's historical journey, renowned Swiss investor Dr. Marc Faber draws attention to the remarkable trajectory of the precious metal's value over the past 7 decades. From its modest price of $35 per ounce in the 1950s to today's impressive valuation of approximately $2,650, gold has demonstrated its exceptional capacity to preserve and enhance wealth, outperforming traditional assets like real estate and everyday commodities such as bread. The 1950s represented an era of unprecedented stability in gold prices, anchored by the Bretton Woods fixed-rate system. During this period, gold prices maintained remarkable consistency, moving only marginally from $34.84 in 1953 to $35.10 in 1959. This stability starkly contrasts the more volatile post-1970 era, when the abandonment of the gold standard introduced new market dynamics. Recent market movements highlight gold's continued sensitivity to economic indicators, despite its reputation for stability. A notable example occurred during North American trading hours when gold prices dipped below $2,630 following the release of November's U.S. non-farm payrolls data. The report, showing 227,000 new jobs against an expected 200,000, alongside an increase in the unemployment rate to 4.2%, triggered this short-term price adjustment. Faber's analysis extends beyond mere price comparisons, emphasizing gold's fundamental role as a hedge against inflation and currency devaluation. His perspective is particularly relevant in today's economic landscape, where he argues that the continued existence of central banks and governments ensures gold's enduring value as a store of wealth. This view supports the World Gold Council's recent observations regarding central bank behavior. The organization notes a growing trend among emerging and developing nations to expand their gold reserves. This strategic shift reflects multiple concerns: the prevalence of low or negative-yielding sovereign debt, escalating sanctions risks, and the potential for currency conflicts. These nations increasingly view gold as a crucial financial security and independence tool in an uncertain global economic environment. Before watching this video, subscribe to our channel, hit the bell icon to never miss an update, and share it with others.
I think I'm one of the few very consistent strategists, economists, observers that has always maintained that people should have some physical ownership of gold, silver, and platinum. Now, sometimes this metal will go up at a faster rate than another one and so forth. But in general, as long as central banks exist, you can be sure that there will be money printing. That's the only thing they know. They may have studied at a university, but they haven't read history, or they don't want to say that they know history, because Greenspan is the last one, the academic, who was very skeptical about what he was doing, but he was doing it anyway because that's the system. He adapted to the system. So he was called the great maestro and so forth. But I have to say, academically, he was a very brilliant man, academically. And he was also a nice person, not an unpleasant character, not at all. But obviously, he was part of the elite of Wall Street. You print money, assets go up, Wall Street earns higher fees. That is the game that is being played. And in this environment, as long as there are central banks in the world, as long as there are governments, precious metals will maintain some of the purchasing power. Now, gold, if I look at the price level when I grew up in the 50s, gold has actually outperformed some items. Like gold has gone up more than the price of a loaf of bread. Or gold was at $35 in 1970. Now it's 2,650 or whatnot. So I can say the gold price has gone up actually more than some buildings. I have to laugh because all I hear is they will never let anything go down because they can print money. Well, in commercial properties, they could print as much money as they like and prices collapsed. Collapse was cushioned by the government renting space and space which they actually don't need. You know, when you look at the expansion of the healthcare sectors, it's not an expansion of knowledgeable doctors that do something, administrate. The expansion in the education department is not teachers that teach something intelligent. No, administrate. People who never worked in their lives, they go and tell entrepreneurs how to run their businesses.
Dr. Marc Faber's analysis highlights a pivotal shift in global economic trends, marking the end of a decades-long period of declining interest rates and inflation. 2020 represented a historic turning point, with the 10-year Treasury yield touching an unprecedented low of 0.57%, averaging just 0.89% for the year before closing at 0.93%. The COVID-19 pandemic played a decisive role in this culmination of the long-term downtrend. The Federal Reserve's aggressive monetary response to the economic crisis pushed rates to historic lows, marking the end of a cycle that had persisted for decades. However, Faber notes that both interest rates and inflation have since reversed course, entering what appears to be a new long-term upward cycle. This shift aligns with traditional central bank policy frameworks, where interest rates are a primary tool for inflation management. The Federal Reserve's target of 2% average inflation guides its manipulation of the federal funds rate, the overnight interbank lending rate. The Fed typically raises rates to cool economic activity when inflation threatens to exceed this target. Conversely, rate reductions aim to stimulate economic expansion during periods of low inflation and sluggish growth. Let's get back to the interview.
We have an environment where until recently, say until 2020, interest rates were trending down and inflation was trending down, maybe not as much as the Bureau of Labor Statistics was suggesting, but it was a downtrend. And now we have an uptrend in essentially inflation, in prices, and we have an uptrend in interest rates. In interest rates and inflation, we have long-term cycles. These cycles are, 40, 50, 100 years long. And we've reached a major low in the interest rate cycle in year 2020 when the 10-year Treasury was at 0.57%. This is not going to happen again. From here on, interest rates will go up, partly because of the deficits. And the deficits, they cannot be eliminated just like this. We have to increase taxation massively or cut spending or both. Or we have to default, is a possibility. Or we have to print money. And every government in history has opted to print money because it's a relatively, initially it's a relatively painless measure that is not visible by the majority of people. The majority of people say, oh, prices are going up because the American media, the dumbed-down media, will say it's Putin, and the government says, yes, it's Putin. Because of him, prices are going up. They don't analyze why prices are going up. The fact is prices are going up because of excessive money printing and fiscal deficits. And it's a tax on the system because the fiscal deficits occur because not enough taxes are collected. So prices then go up, and that is the tax ordinary people pay. And wealthy people, the financial sector, including myself, we benefit from money printing because our assets, including precious metals and so forth, go up in value.
Gold has long been recognized as a stable store of value, particularly in times of economic uncertainty. As inflation rises and central banks adjust interest rates, gold remains an attractive asset for investors seeking to preserve wealth. With its ability to retain value over time, especially in response to fiscal deficits and monetary policies, gold plays a crucial role in global financial markets. What do you think lies ahead for gold in today's economic environment? Drop your thoughts in the comments below. If you enjoyed this video, like, subscribe, and stay tuned for more insights. Thanks for watching.